Let's talk today about private mortgage insurance, known as PMI for short, and why, if possible, it's good to avoid paying PMI. So what is PMI? PMI is an insurance policy on your mortgage that protects a lender from a default on the mortgage in case the person who takes out the loan defaults on their payments. When do you have to pay PMI? You pay PMI, generally speaking, there are some exceptions, if you have a lower than 20% down payment when you buy your house, okay? When you have a lower than 20% down payment, you are going to be told, we'll approve you for the loan, but you are a higher risk because you have less equity, and you've got to make that up by giving us an extra payment called a private mortgage insurance payment. The payment is usually a monthly installment. It gets added on to the total of what you pay per month. In some cases, you're allowed to make the PMI payment as a lump sum at the mortgage origination. And once you've made payments over a period of time, and you've built up that 20% equity in the house, either because you've paid in enough or the value of the property has gone up such that you have 20% equity, you can request that the policy be canceled. Now, how much does PMI cost? It varies, and the rate it varies on the amount of your mortgage and your credit score, geography in some cases, and different factors. If you have great credit, so with not B, let's see, what am I doing here? So if you have great credit, you would expect PMI to be somewhere between 0.6% and 1.0% of the original loan amount, okay, as an annual premium. So over the course of a year, if you have a mortgage that is $300,000, you would probably pay somewhere in the range of, $2,000 up to, we would say $3,000, but it could be more expensive. Your credit might not be so good. Maybe $5,000 a year, obviously divided over 12 months. When you hear the percent, it doesn't sound that bad, but when you picture it in dollars, it really is a lot of money. The other issue is it can take a long time to get up to that 20% equity and finally be able to do away with the PMI. You might think, well, it's a few years, but remember that early on, there's this, if you look at amortization, you start with interest and principal. Your payments, I actually don't remember whether it's a straight line or whether it's sort of like in any case, your early payments are overwhelmingly interest. So you're making very little progress towards actually building equity in the house. So it could take a decade before, depending on how much you put down, to build enough equity to get rid of that private mortgage insurance. Could be 20 grand, 50 grand, could be a lot that you end up paying in PMI, especially when you consider the opportunity cost of that money. You could be making 7% in the market on the money you're paying in PMI. Now, making matters worse, PMI is no longer tax deductible like it was before the Trump tax cuts of 2017. And it's also important to point out that some lenders require you to maintain a PMI contract for a designated period, even if you get to 20% equity. So make sure you know the terms of what you're getting into. Now, if you want to buy a house, but you don't have a 20% down payment yet, what does it make sense to do? There is no one answer. Some might say you just got to wait before buying the house. Or maybe you look at a smaller house. Maybe you look at a different market. Maybe you look at getting a loan from friends and family, probably not friends, family, depends what kind of friends you have, but that can be very dicey, but getting a personal loan from someone else. And often these things are easier said than done, but it's important to understand the effect of PMI every single month. Now, there's one counterpoint that I think is important to mention. Some will argue, you're actually better off putting down as little as possible. Put down 3% on your house if you can, and take the 17% you were going to put down and put that in the market earning 7%. In other words, pay the PMI, but take the money you didn't put down and put it into the market. This is not a typical scenario for most people, so I'm not going to address it in detail right now, But whether that makes sense depends on a number of factors, including the rate of the PMI, your financial situation, the cost of the house, the time horizon for that stock market investment, and many other things. It's not as easy as that does or doesn't make sense. Maybe we'll do another video about it.